Did you know that buying a $25 pizza with Bitcoin in 2010 could cost you thousands in taxes today? Back then, Bitcoin was a novelty, and few could have predicted its meteoric rise in value. That simple pizza purchase, now legendary in crypto circles, is a prime example of how the IRS views cryptocurrency transactions. That's right, the IRS wants its cut of your crypto profits. Every transaction, whether it's buying a pizza or trading coins, is potentially taxable. The IRS considers cryptocurrency as property, meaning each transaction can trigger capital gains tax. Cryptocurrency might seem like a digital Wild West, but the long arm of the law, in this case the taxman, is reaching into the blockchain. The decentralized nature of crypto doesn't exempt it from regulation. In fact, the IRS has been ramping up efforts to ensure compliance. Just like with your regular income, you're required to report your crypto gains to the IRS. This includes not just profits from selling or trading, but also income from mining, staking, and even receiving crypto as payment for goods or services. Ignoring crypto taxes is a gamble you don't want to take. The IRS has sophisticated tools and partnerships with exchanges to track down unreported crypto income. The risks of non-compliance are high. The penalties for tax evasion can be severe, including hefty fines and even jail time. It's not just about paying what you owe, it's about avoiding the additional costs and legal troubles that come with evasion. So, whether you're a seasoned crypto trader or just dipping your toes into the digital asset pool, understanding your tax obligations is crucial. Consulting with a tax professional who understands cryptocurrency can help you navigate these complex waters and ensure you're compliant with all regulations. Many people dive into the world of cryptocurrency thinking it's a secret, untraceable financial haven. Think again. While transactions on the blockchain are pseudonymous, they're far from anonymous. The IRS is cracking down on crypto tax evasion, using sophisticated tools to track transactions and identify taxpayers. They collaborate with exchanges and employ blockchain analysis companies to follow the money trail. Hiding your crypto holdings from the IRS is like trying to camouflage an elephant in a phone booth. It's not going to end well. So before you start picturing yourself sipping cocktails on a private island with your untaxed Bitcoin, remember that the IRS is watching. Here's the gist of how the IRS views your crypto. It's property, not currency. This classification has significant implications for how your crypto transactions are taxed. That means every time you sell, trade, or use crypto, it's a taxable event, just like selling stocks or real estate. Each transaction must be reported and the gains or losses calculated. Buying and holding crypto is fine. You won't owe any taxes until you dispose of it. This means you can buy and hold your crypto assets without worrying about taxes until you decide to sell or trade them. But once you start making transactions, things get a little more complicated. Each transaction, whether it's a sale, trade, or purchase, needs to be tracked and reported. Short-term gains, holding crypto for less than a year, are taxed as ordinary income. This means they are subject to the same tax rates as your regular salary or wages. Long-term gains, holding for over a year, qualify for lower capital gains tax rates. These rates are generally more favorable and can save you money if you hold your crypto for a longer period. And yes, even using crypto to buy goods and services is a taxable event. Every time you use crypto to make a purchase, you need to calculate the gain or loss from the transaction. That $5 cup of coffee you bought with Bitcoin? Yep, the IRS wants a piece of that too. Even small transactions need to be reported and the gains or losses calculated based on the value of the crypto at the time of the transaction. Get ready to embrace the world of tax forms. It's that time of the year again, and if you've been dabbling in the world of cryptocurrency, there are a few extra steps you'll need to take to ensure you're compliant with the IRS. The IRS has a few specific forms you'll need to familiarize yourself with when dealing with crypto taxes. These forms are crucial for accurately reporting your crypto transactions and ensuring you don't run into any issues down the line. First up is Form 8949, Sales and Other Dispositions of Capital Assets. This form is essential for detailing every single crypto transaction you've made throughout the year. This is where you'll report your crypto gains and losses from trading. Whether you've made a profit or a loss, each transaction needs to be meticulously recorded here. Next, we have Form Schedule D, capital gains and losses. This form is used to summarize the information from Form 8949 and other sources of capital gains and losses. This form summarizes your capital gains and losses from all sources, including crypto. It's important to ensure that all your gains and losses are accurately reflected here to avoid any discrepancies. And finally, if you've received any crypto as income, for example, from mining or airdrops, you'll need to report it on Form 1040 U.S. Individual Income Tax Return. This form is the cornerstone of your tax return and includes all your income sources. Don't worry, it's not as daunting as it sounds. With a bit of organization and the right resources, you can tackle your crypto taxes with confidence. There are plenty of resources and software options available to help you navigate the crypto tax maze. From online guides to professional tax advisors, you have a wealth of support at your fingertips. So take a deep breath, gather your documents, and get started on your crypto tax journey today. Section 5. Calculating your crypto fortunes and misfortunes. Calculating your crypto gains and losses might sound like trying to solve a Rubik's Cube blindfolded, but it doesn't have to be that way. The key is to keep accurate records of all your crypto transactions, including dates, amounts, and the cost basis, the original price you paid for your crypto. For every crypto transaction, you'll need to determine the fair market value of your crypto in US dollars at the time of the transaction. This information is usually available on cryptocurrency exchanges or price tracking websites. Remember, even small transactions add up, so don't overlook those seemingly insignificant trades. Section 6. Reporting your crypto capers on your tax return. Now that you've gathered all your documents and calculated your crypto gains and losses, it's time to report this information on your tax return. You'll need to transfer the information from Form 8949 to Form Schedule D, and then include it on your Form 1040. Make sure to check the appropriate boxes on your tax return to indicate that you've engaged in virtual currency transactions. It's crucial to report your crypto activity accurately and honestly. The IRS is actively looking for discrepancies, and any inconsistencies could trigger an audit. Section 7. Don't be a crypto tax clown. Common mistakes to avoid. Even seasoned investors can trip up when it comes to crypto taxes. Here are some common mistakes to avoid. Ignoring small transactions. Every trade counts, even if it's just for a few bucks. Poor record keeping. Accurate records are crucial for calculating your gains and losses. Misunderstanding tax rules. Crypto tax regulations can be complex. Do your research or consult a professional. Trying to hide crypto assets. The IRS is cracking down on tax evasion. Don't even think about it. By being aware of these potential pitfalls, you can navigate the world of crypto taxes with confidence. Section 8. Crypto tax software. Your digital tax man. Don't worry, you don't need to be a math whiz or a tax attorney to handle your crypto taxes. There's a growing market of crypto tax software designed to simplify the process for you. These software programs can connect to your cryptocurrency exchanges and wallets, automatically import your transaction history, and calculate your capital gains and losses. Some software providers even offer direct filing options, allowing you to submit your tax return electronically directly from their platform. Section 9. Seeking professional help for your crypto tax tango. If your crypto transactions are complex, involve multiple exchanges or wallets, or you're just feeling overwhelmed, it's always a good idea to seek professional help from a qualified tax advisor. A crypto-savvy tax professional can help you navigate the intricacies of crypto tax regulations, ensure you're claiming all eligible deductions, and minimize your tax liability. Remember, attempting to handle complex crypto taxes on your own can be risky. Seeking professional guidance can save you time, money, and potential headaches down the road. Section 10. The future of crypto taxes, a world of uncertainty. The world of crypto is constantly evolving, and tax regulations are struggling to keep up. What's considered a taxable event today could change tomorrow. The IRS is still working on clarifying many aspects of crypto taxation, and we can expect to see new guidelines and regulations in the future. Staying informed about the latest developments in crypto tax law is crucial for ensuring compliance and avoiding potential penalties. Section 11. Like, share, subscribe, and stay out of crypto tax jail. That's it, folks. You're now equipped with the knowledge to conquer the wild world of crypto taxes. Remember, understanding your tax obligations is key to enjoying your crypto profits without the fear of an IRS audit. If you found this guide helpful, be sure to give it a thumbs up, share it with your crypto-loving friends, and subscribe to our channel for more insightful content. And as always, stay informed, stay compliant, and stay out of crypto tax jail.